who really has found there's two recurring themes in for senior homeowners in their academic research he's done, and that is, one is to want to try to help their adult children. We've all seen that situation. The other is the fear of running out of money. And both of those fears or needs can be addressed constructively with a reverse mortgage. And that's really what all our education is about, is to how to use what's potentially the client's biggest asset to protect their other assets and to meet their needs, like taking care of their adult children or not running out of money. So with that, we'll bring Wade up, who's the author of the Retirement Planning Guidebook and How to Use a Reverse Mortgage to Secure Your Retirement, PhD, RICP, and CFA, Wade Pfau. Welcome.
Thank you, Scott, and thanks for the introduction. Thanks, everyone, for coming today. So I'd like to spend some time talking about kind of the evolution I went through with being someone more in the financial planning, retirement planning side, not really thinking that reverse mortgages, I know I should look at it at some point, but it wasn't a high priority, just a conventional wisdom. It's not really something you need to be thinking about. Then in about 2014, getting introduced to them through John Salter, who's at Texas Tech University and prominent financial advisor himself, he sent me a stack of articles about research on reverse mortgages, read through that, and thought, well, this is a really interesting thing to look at. I've really been able to build a career out of writing simulation, computer code to simulate retirement strategies. There's a lot of really interesting features of the home equity conversion mortgage, reverse mortgage line of credit, growing line of credit with a variable rate HECM, that made it a very interesting thing to look at and to compare different approaches. How can I build a strategic retirement plan if I have a household with just basic, they have an investment portfolio and they have a home and they have a retirement spending goal? How can they most effectively meet that retirement spending goal and at the same time preserving assets for legacy or for just if they live even longer than they planned for and so forth? And that's where the reverse mortgage really brought up a lot of interesting opportunities to build a retirement plan where if you strategically incorporate at a younger age the growing line of credit with the reverse mortgage, you could have better financial planning outcomes than if you use a conventional wisdom idea, which is the last resort. That, well, if I ever run out of investment assets, then I'll consider a reverse mortgage at that point. I'll show, based on looking at historical market returns with today's tax rules and today's reverse mortgage rules, how that last resort approach generally is the worst way to think about a reverse mortgage. That if you open the reverse mortgage earlier than it may be needed to let the line of credit start to grow, you can lay that foundation for better financial planning outcomes. During the happy hour today, the book up here, the reverse mortgage book, will be available if anyone would like a copy. You don't have to go to Amazon or anything. There'll be copies here. Happy to also sign them at the happy hour. And what I was originally doing was I was trying to write the Retirement Planning Guidebook. This book finally came out in 2021. It took about 10 years to write, but kind of the genesis of the reverse mortgage book was, as I was writing the chapter on housing, retirement housing, it kept getting longer and longer. It's 120 pages long. That's too long for a book chapter. I realized I actually had a book. And so the first book I wrote was the reverse mortgages book. It was maybe a way to test, well, how does it work to be an author and to sell books and so forth. But eventually leading into the Retirement Planning Guidebook, which is a more complete look at all the different aspects of a retirement plan. And so real quick on just the foundation of, I've over the years tended to get a lot of tomatoes thrown at me because I talk positively about financial products that the conventional wisdom seems to not necessarily have a good impression about, whether it's annuities, whether it's reverse mortgages. But the reason for all that is coming to recognize and understand how the retirement income planning problem is fundamentally different from the pre-retirement investment management wealth accumulation problem. Pre-retirement, it's all about modern portfolio theory. You build a diversified portfolio to seek the highest risk-adjusted returns. And if you start to dig into those assumptions, modern portfolio theory is an assets-only model. It's how do you maximize risk-adjusted returns when you're not trying to fund any liability. The retirement problem is you have to fund a liability. It's an asset liability matching problem. And that changes a lot of things. And so this analogy of mountain climbing, the idea is if you're climbing a mountain, the naive thought is the goal is to reach the top of the mountain. You have to safely get back down the mountain as well. With mountain climbing, most accidents happen on the way back down, not on the way to the top. And it's the same with retirement planning, where the naive goal is, well, I'm trying to achieve some sort of wealth accumulation target. If I can save X number of dollars, I can retire, and that's the goal of retirement planning. The reality is you have to safely sustain lifestyle over an unknown time horizon. Most of the accidents happen on the way down. I can no longer rely on work. There's market volatility that will create the sequence of returns risk when I'm spending from my portfolio, so that there's a market downturn. Even if the markets recover, if I'm spending from my portfolio, I'm selling an increasing percentage of what's left. My portfolio won't recover with the overall markets. Don't know how long I'm going to live. There's different spending shocks that can happen, all kinds of things that I haven't budgeted for related to healthcare, long-term care, and so forth. And I have to build a plan to manage these risks. And I may have investment assets to do that. I have Social Security. I have home equity. It could be a lot of other assets too, but to keep the problem more manageable, we're really thinking about how can I coordinate my home, my investments, Social Security to some extent, and actually, and I won't talk about it today, but just looking at different Social Security claiming strategies and building a bridge to delay Social Security with the reverse mortgage is another option. How can I coordinate all this to get the best retirement planning outcomes? And strategic use of the reverse mortgage has a very positive impact on that conversation. And so that's what I want to work through in today's presentation. Now, we need to, with retirement planning, manage these different risks: longevity risk, the overarching risk of retirement. The longer one lives, the more expensive it is to fund their retirement. And there's a risk that eventually they run out of assets. And also with a longer retirement, it's just more time for changing interest rates, market losses, sequence of returns risk, inflation, different spending shocks to have an impact and to affect the ability to sustain lifestyle over that retirement horizon. So this is how I view building a retirement income plan. The 4 L's are the financial goals on the left: longevity, lifestyle, legacy, and liquidity. They map into liabilities or expenses on the right. The longevity goal is about meeting essential spending. Lifestyle goal is about meeting the discretionary expenses to create the best overall lifestyle in retirement. Legacy is about what to leave on to the next generation. And then liquidity is about having reserves, not earmarked for other purposes, available for contingencies that I haven't budgeted for with my essential or discretionary spending. Major bills that come due that were not part of the budget. And then retirement income, asset liability matching, I have to position assets to meet these liabilities. And I can break those assets down into reliable income, diversified portfolio, and reserve assets. Now, the default for home equity is it's usually just treated as a reserve asset. It's not really treated as part of the retirement planning or financial planning process. There's a home that we could potentially sell at some point in the future if necessary, because we run out of other options. We've depleted the investment portfolio. We just don't have enough through the reliable income to meet our expenses. Now, you could still treat the home as a reserve asset, but I'll talk more about the simulations behind this. Opening a line of credit on the reverse mortgage before it may be needed, letting that line of credit grow, can lay the foundation to have more spending power from that asset in the future. And then also, there's ways to treat the home equity as part of the reliable income or diversified portfolio. The reliable income, there's an option called the tenure payment, Tenure, not 10 years, it sounds like 10 years, but tenure payment that provides an ongoing monthly income. It behaves a lot like a lifetime annuity. It does have an important asterisk that you get this monthly payment for as long as you remain eligible for the loan, which means you continue to live in the home and maintain homeowner obligations, but otherwise it could last for a lifetime. And the way it acts like an annuity, there's a mortality credit component. Even if you use up the entire borrowing capacity of the reverse mortgage, the 10-year payments are guaranteed to continue beyond that point for as long as you're eligible for the loan, so as long as you're living in the home and maintaining the homeowner obligations. It becomes a reliable income asset. Or you could really treat the home equity as part of the diversified investment portfolio. And this is what a lot of the research in the Journal of Financial Planning going back to 2012 really highlighted this idea of a coordinated strategy. I'm going to strategically spend from my investments in some cases, borrow from the line of credit in other cases, to coordinate those two assets to support greater long-term spending. And that's really a way to treat the home equity as part of the diversified portfolio. Or again, it could still be part of the reserves, that you open the line of credit, you allow it to grow. And I'll talk more about the growing line of credit is the secret magic of why this is a really powerful tool. So I'll talk more about that shortly. But you open the line of credit, allow it to grow, and then you have more assets for the future to use for whatever sort of contingencies may happen. Whether you end up outliving the investments, whether you need to pay for an in-home care, aging in place, whatever the case may be. Well, these are potential uses for the reverse mortgage, and I break them into 4 general categories, and then there's some sub-examples as well. Most of these have a section looking at them with simulations in my book. I won't be digging into all of them today. I'll focus on the portfolio coordination strategies for the case study today, but a lot of these are in there. The first 4 broad categories. The first is portfolio coordination for retirement spending, and that's what I was explaining about. When do I draw from the investments? When do I draw from the home equity? Well, I could treat the reverse mortgage as the last resort, but I'll show how that's usually the worst way to do things. I could use the 10-year payment option to reduce the pressure of how much I have to take from my investments to meet my spending goal, because part of my spending goal is covered through the 10-year payments. Or I could use a coordination strategy where I'm strategically deciding when my portfolio is in trouble, I'll temporarily spend from the reverse mortgage to fill that spending need without drawing from a declining portfolio. So different options there. The next category is portfolio coordination for housing. Now, the most common use for the reverse mortgage is simply more Americans are carrying traditional mortgages into retirement. That creates a fixed payment. Say I have 10 more years on the mortgage, a fixed large payment with no discretion in the first 10 years of retirement can really amplify sequence of returns risk, because I've got this bigger spending need. If there's a market downturn, that can create a lot of problems, even though the mortgage payments will eventually leave. But if I refinance that traditional mortgage into a reverse mortgage, it reduces that spending pressure from the early years and pushes that liability off into the more distant future. So refinancing an existing mortgage, there is the HECM for Purchase program now for purchasing a new home and being able to expand the access to like what could potentially be used, because part of that will be financed through a reverse mortgage. And also aging in place is popular. People may want to stay in the home, but it requires something significant, like putting a bathroom in on the ground floor, or putting in an elevator, or just making wheelchair accessibility, widening the hallways, something that's going to be expensive, but if they could do it, it would allow them to stay in the home for much longer. The reverse mortgage could provide a way to fund home renovations to support aging in place. Then the next category is a funding source for retirement efficiency improvements. So a lot of like my writing on retirement income planning is generally this idea of if you pay some sort of short-term cost, you can create long-term benefits that more than exceed the cost and give you a better planning outcome. Whether it's delaying Social Security, whether it's doing a Roth conversion, whether it's considering an annuity as part of the retirement strategy, whether long-term care, just something where paying today could help in the long run, well, you need to fund those short-term costs. The reverse mortgage can provide a way to do that. So if somebody's retired at 62, they're thinking to delay Social Security to 70, that's great, and it's okay to go ahead and spend down from their other assets in the meantime, because their benefit at 70 is going to be so much larger than it would be if they took it at 62. But if they simply just draw a bigger amount from their investments until they turn 70, there's more sequence risk. They don't necessarily want to, I mean, there's options. Maybe they could build a bond ladder for that 8-year window until Social Security starts. Or another option is with the reverse mortgage, they could create an 8-year term payment that will cover part of that missing Social Security benefit, put less pressure on their investment portfolio, create more opportunity for their investment portfolio to grow over the long term and to support a better financial planning outcome. Recently, I've really been interested in the tax-efficient retirement distributions that can really speak to the value of using Roth conversions in the years before Social Security begins, in the years before RMDs begin, to really help manage the Social Security tax torpedo, IRMA, the Medicare surcharges once incomes get to higher levels, how RMDs can unintentionally force people to pay much higher taxes than they anticipated, even though they may not necessarily want to spend that money. They can reinvest the RMDs, but they do have to pay taxes on it, and that can have some unsettling impacts. And also just another thing that a lot of folks don't realize is just your preferential income, so your long-term capital gains, your qualified dividends, they stack on top of ordinary income. And that can really push up the effective marginal tax rate, where if I'm taking money out of my IRA, I may still be in the standard deduction or the 10% or the 12% bracket, but then that's pushing part of my capital gains from the 0% to the 15% bracket, pushing my effective marginal tax rate up to whether it's 25% or 27% or just 15% if I'm still in the standard deduction with ordinary income. Using the reverse mortgage, as it doesn't go into adjusted gross income. So if I need to meet a spending need and I do proceeds from a loan, I don't have to take from my IRA, I don't add to my adjusted gross income. That can help with the Social Security taxation, with the preferential income taxation, with the Medicare premium surcharges, with a net investment income tax, and so forth. So potentially using the reverse mortgage as a resource to meet spending without adding to my adjusted gross income and causing all kinds of problems for my retirement. And then also, if I had an existing long-term care policy, there's been problems where the premiums keep going up. And at some point, that may start to look less affordable. Well, simply using the reverse mortgage to continue paying the premiums on an existing long-term care policy could be another option there. The final category, preserving credit as an insurance policy. So this is, I'm going to open the line of credit, I'm going to let it start to grow, and then I could use it for any number of different things that might happen. Whether it's another way, I could go ahead and just spend on my investments. If I deplete my investments, then I've got the much larger line of credit to start tapping into. When I first got interested in reverse mortgages, there was this idea of protecting the value of the home. So once the reverse mortgage is initiated, the line of credit grows independent of the home value growth. So if the home value stagnates, there can get to be situations where the line of credit could grow, and you'll even see in the example later. It's less likely to happen. There was a rule change in 2017 that took some of the fun out of this strategy. But the line of credit can grow to exceed the value of the home, especially if the home value stagnates or declines. And you could really then think about it as a way to help protect the home value. That's just another option here. Or simply as a source of contingency funds for various spending shocks, to pay for in-home care, to cover health expenses. There's a lot of interesting uses with divorce settlements. The basic idea there is if the divorcing couple wants to, one of them keeps the home, but then use the reverse mortgage to unlock equity to pay off the other individual, or they could sell that home, each get half of the value, and then with the HECM for purchase, assuming this is part of a responsible plan, could then they could each get their own home of a similar value using the HECM for purchase program. So a couple different divorce settlement cases that are interesting to look at. Now, building a retirement income plan, and this is what we're going to look at a case study to just demonstrate how this all comes together. These are different options for managing retirement risk, managing the risk of how do I fund this liability in the face of the market volatility, where when I'm spending from my assets, it amplifies the impacts, and in the face of longevity, where I don't know how long I need to stretch out those funds. Well, I could spend conservatively, and this means from my investment portfolio. If I spend less from my investments, that helps stretch those investments out for longer. So there's a lot of reverse mortgage use cases here where I can use the reverse mortgage to help reduce the spending pressure on my investments. Whether it's that monthly 10-year payment to cover spending needs to reduce the distribution need for my investments. Whether it's refinancing a mortgage to take that fixed mortgage obligation out of those early retirement years. Whether it's the Social Security delay bridge to help support more spending from Social Security after 70, but to help to get to that point without having to take as much out of the investments until age 70. The next category is spending flexibility, and the idea here is cut spending after a market downturn reverse mortgage doesn't do anything there, because the whole point is you don't have to cut spending. So I don't have a use case for cutting spending. Reducing portfolio volatility in a strategic manner. But then the fourth approach here, this is where reverse mortgages come back into play. So buffer assets, something held outside of the investment portfolio that's not correlated with the portfolio, and that can provide a temporary spending resource to help preserve that portfolio in the face of market volatility. A reverse mortgage is a classic example of a buffer asset. And I really am only comfortable saying three things are buffer assets. The original one is cash. You've got like a big cash pile on the sidelines. It's not treated as part of the portfolio, but it just provides something to tap into during market downturns. You've got the growing line of credit on the home equity conversion mortgage or reverse mortgages. And then in the life insurance world, there's a parallel conversation about using the cash value of a whole life insurance policy, this non-decreasing asset that, or at least access to asset that's non-decreasing, that you can tap into. It's proceeds from a loan, so it's not going into adjusted gross income and so forth. But a buffer asset approach. And that's where the case study I look at for this presentation is focused more on looking at the 10-year payment and also looking at a portfolio coordination strategy. Now, before getting into the case study, there's a lot of intuition in these next two slides. I'm not introducing the reverse mortgage yet, but I'm starting to show why the reverse mortgage might help. And it's related to the synergies about how small changes in how you distribute from your investments can have a huge impact on the long-term preservation of those investments. It's what sequence of returns risk. It has all these odd nonlinear impacts that explain why, even though a reverse mortgage, there's a cost to set it up, it can create these long-term benefits that more than exceed the costs. So what we're looking at here, it's similar to the idea of the 4% rule. It's not modeled directly after the 4% rule. The 4% rule was a 34-year retirement. Other characteristics, I'm sorry, a 30-year, this is a 34-year. The 4% rule is 30 years. But this is, if I just got the market returns to a 60-40 portfolio, S&P 500, 10-year treasuries, the market returns from 1962 through 1995. So this is a 34-year time horizon, inclusive of those years. $1 million in 1962, if I use a 3.95% withdrawal rate, which is an initial withdrawal rate, if I took at $1 million, I take $39,500, and then I increase that level of spending each year by the historical inflation, I run out of money at the end of 1995.
Yes, sir. The Case Shiller, the Robert Shiller data, 62 to 95, 60%, 40% treasuries. What does it look like from 94 to 24? And how much, my investment counselor wants me to have 90% or 100% of my money in the market because I've got 20 years to live according to an actuarial table. So I just wonder what your current, is there a current consensus based on?
Yeah, so the question is about like the historical.
Repeat the question.
Yeah, with the historical data, like, why did I pick 1962? What would it be like with different years? I don't have that figure in this presentation, but at the very beginning of the Retirement Planning Guidebook chapter on investments, it shows the whole historical data. Like 1994 to the end of 2023 is our most recent 30-year period. The withdrawal rate's not that bad. I don't remember the exact number, but it's going to be in the 5 or 6% range.
Does come out similar is the idea?
Oh yeah. This is not the worst case in history, but it's a cousin of getting close to the. You'll be able to see a little bit later in the presentation too. I didn't cherry pick this for the purpose of picking a worst case scenario. With the data Bill Bengen uses to create the 4% rule, 1966 is the worst case retirement year, 66 to 95. Now we're to the point, we're getting to the late 1990s where we can look at 30-year horizons. I was worried for a long time 2000 is going to create a new worst case scenario. We're still a few years away from knowing that. It looks like it won't be a new worst case scenario. Markets did recover well enough after downturns in the early 2000s and then the financial crisis. But 1962 is kind of a bad year to retire, but not the worst. And it's not necessarily worse more recently. Now, if you're retiring today, then you really care about what are the market returns from 2024 through 2053, and that, of course, we're not going to know for quite a while. Okay, but in this case, spending the portfolio down to zero with a 3.95% withdrawal rate. The point of this is to start to create the intuition that if I just lower the withdrawal rate a little bit, it has a huge impact on portfolio survivability or sustainability. So from 3.95 down to 3.75, 20 basis points less, I still have $1 million left in 1995. And it's not inflation adjusted, but it's like if I had $1 million in 1962, I still have $1 million in 1995 by spending 3.75% instead of 3.95%. If I went down to 3.55%, I have more than $2 million left at the end of 1995. Now here is kind of the intuition about the 10-year payment, because it's not that I have to just spend less in retirement, but if I could source that difference, we're talking about $2,000 a year or $4,000 a year, if I could source that to a reverse mortgage, it's going to dramatically improve my portfolio. So then the question becomes, is the cost of using the reverse mortgage greater than the benefit to the portfolio? Now that's what I'll answer in the case studies. The answer is not here, but this is setting up the intuition, and to give you the punchline coming up, generally, no, the cost of the reverse mortgage would be less, so that you can pay off the loan balance with these investment improvements and still have some money left over at the end. Okay, that's kind of the direction we're heading with this, that the reverse mortgage is going to strategically use with the investment portfolio can lead to a better outcome, where I'm going to calculate legacy as what's left in the investments plus the value of the home minus the loan balance if a reverse mortgage is used. And if that number is bigger through a strategic use of reverse mortgage and through a last resort option, which may never even use the reverse mortgage, I've got a better outcome. Now, children generally don't want their parents' home, but if they did want it, well, if they have more investment assets, because we can't look at the reverse mortgage in isolation. It has to be looked at as part of the entire financial planning picture. If we're helping the investments, they can pay off the loan balance and keep the home. And if you're new to reverse mortgages too, an important detail is it's a non-recourse loan. So the beneficiary, if it goes to that point, is not on the hook to pay back more than 95% of the appraised home value at that time. So if the loan balance exceeded that, there's no home equity left. But again, by spending less from their investments, it's laying that foundation for the investments to perform better over time. And this is kind of a buffer asset version of this. This is how Barry Sachs, he wrote the original research article that pointed out how strategic use of a reverse mortgage line of credit can improve financial planning outcomes. He talked about skipping distributions from the investments in years after a market downturn. So this is the same 34-year retirement. If I took the distribution 3.95% all 34 years, I end up with zero in 1995. If I skip just one distribution, so I take 33 of the 34 distributions, I still have either more than $750,000 or closer to $900,000 left, skipping just one of the distributions. Now that's not random. The S&P 500 was down pretty significantly in 1969, 73, and 74. So I'm looking at, well, what if I skip spending from the portfolio in the year after a market decline? So if I skipped in 1970 or 74 or 75, still have a huge chunk of that money left. Now the reverse mortgage isn't part of this yet, but the idea is, well, I wouldn't just skip a year of spending if I source that year to the reverse mortgage, as long as the cost of 1 year's spending does not exceed that number with the loan balance growth, I have a better outcome. And if the line of credit could have supported skipping all 3 of those years, I still have $2.25 million left in the investments.
Two quick questions. So when you have to start taking required minimum distributions, are you just reinvesting in your mortgage account at that point?
There's no taxes in this chart, but in the case study I'm going to do, yes, potentially. I fully incorporate taxes into the case study. They take any required minimum distributions due. They're going to pay taxes on it. If they end up having more than they need with the RMDs, it does get reinvested in the taxable account.
Which leads to the next question. Why isn't the year after the market's down? Why wouldn't you do
Well, the other kind of simple assumption here is you just take the year spending at the start of each year.
Okay.
It's based, that's what a lot of the retirement income research is, just based on annual data. Take the distribution at the start of each year. So it's like, well, at the start of the year, I see last year the market was down, so this year I'm going to take the spending from the reverse mortgage instead of the portfolio.
Thank you.
Yeah, that's a great question. That's an assumption I didn't mention, but it's important. Annual distributions at the start of each year. Okay, now I've got a section on how reverse mortgages work. This is something you can find all over the place, and if a loan officer invited you today, they can also quickly review this type of information with you, so I don't want to spend much time on it. You do have to be 62 or older, does have to be a primary residence. You can see some of the other characteristics here, but I'm not the person to cover this for you. This is some of the basic ideas. I do want to get into the case study to make sure we have time to go over that, but these are important details if you're brand new to the reverse mortgage world. There are protections now for eligible non-borrowing spouses. If one spouse is over 62, the other is younger than 62. That younger spouse wouldn't be a borrower, so if the borrower passes away, the eligible non-borrowing spouse is protected to continue to stay in the home. They can't take more funds out of the loan, but they can continue to stay in the home. And that principal residence or primary residence is important. Can't do it on vacation homes or that sort of thing. With the HECM program, this is the government home equity conversion mortgage, government administered program. There is a lending limit on the home values. So the home can be worth anything, but the reverse mortgage would only apply on the first, about $1.15 million of the home value. Now, California, this can be an issue. There are also proprietary reverse mortgages that I'm not talking about today. I'm talking about the home equity conversion mortgage program. But if you have a $5 million home that you're looking at, you'd probably also want to consider a proprietary option.
Do most of the benefits for the proprietary, are they as applicable as the HECM?
So the question is about with the proprietary options. There's one example where there's a very limited line of credit, but for the most part, proprietary options don't have the growing line of credit. And that's a big part of what I'm talking about today. That's a characteristic only of variable rate HECMs, which, well, HECM, that's usually what people mean when they say reverse mortgage. And then the variable rate, I used to say it was more than 90% of all HECMs are variable rate. In 2023, it got up to over 99%. So just make sure you don't accidentally get a fixed rate HECM if you want a line of credit. It's the variable rate HECM. Okay, so this is worth spending a little bit of time on, though, because this gets into how the growing line of credit works. So there's a few key terms to start getting familiar with. The principal limit is really the borrowing capacity of the reverse mortgage. The principal limit factor is the percentage of the home value that you have for the principal limit up to that $1.15 million limit. And then you have these two interest rates that both start with E, so they're confusing. You've got the expected rate, which will be used to determine the initial principal limit, and you have the effective rate, which will be for the variable rate HECM with the line of credit, how that line of credit or how the loan balance or how the principal limit will grow over time. So the expected rate is, there's a few variations on this theme, but to give you the basic idea, it's a 10-year treasury rate or some other variant of that. I'll just simplify with a 10-year treasury rate plus a lender's margin that's built into the contract, and then that will give you the initial borrowing capacity. The effective rate will be a short-term interest rate, could be 1 month, could be 1 year. Doesn't have to be a treasury rate, but again, I'm sticking to treasury rates. Plus a lender's margin, plus a 0.5% mortgage insurance premium. And that is going to impact, and this is where the conversation around the growing line of credit gets into play. Let me just check the next, yeah, okay, I'll have a good picture. So I'll wait to get into that for just a second. But that's going to impact all these factors that'll be more clear with the pie chart coming up on how that principal limit will grow over time. So a quick example, if the 1-year treasury is at 5%, 10-year treasury is 4.2%, if the lender's margin is 2.5%, then you've got an expected rate of 6.7% that would be used to determine the initial borrowing levels. And then initially the effective rate would be 8% there, but the short-term interest rate is variable and will get adjusted on a monthly basis. Okay, so the principal limit is equal to the loan balance plus the line of credit And then in some cases, there could be a life expectancy set aside to make sure that the household has enough funds to pay their property taxes and homeowners insurance and so forth. So those things all add up to the principal limit. To make this a little simpler, let's assume there's no set-asides required. So to just keep it simpler, principal limit is loan balance plus line of credit. Now, they're all going to grow at the same rate. And this was the interesting financial planning implication that was probably not the intention of government policymakers when they created the rules for the program. They assumed people would just borrow from it. The reason they get the reverse mortgage is they want to get the funds out. So if they take 100% of what they can, the loan balance is 100% of the principal limit. And you can understand why the loan balance grows over time with interest. Well, the financial planning implication is you need a minimal loan balance to keep the line open. It could be $50 or $100. But otherwise, the rest could be line of credit. And this is where it probably wasn't the intention, but the line of credit grows at the same rate the loan balance would be growing at. Because this composition always stays the same. It's really the principal limit is growing at a variable rate over time. If I have half of the principal limit in the loan balance, half in the line of credit, each of those halves is growing at the same rate over time. Now I can make a voluntary repayment, move money from the loan balance back into the line of credit, and then once I change the composition, they'll continue, their chunks will grow at the same rate, same variable rate over time. I can borrow from the loan balance, borrow from the line of credit, move it over to the loan balance, changing the composition again, but then subsequently they're all growing at the same variable rate over time. So the line of credit grows at the same rate the loan balance would be growing. That's the secret sauce of setting this foundation to get this started at a younger age, even if it's not needed right away, so that you can have more borrowing capacity later.
Why would they not have to change that if it was an oversight?
Okay, so the question is, why would they not have changed it if it was an oversight? They did partly do this. So 2016 was the year I really got into reverse mortgages because there were some oversights with Social Security, filing restricted applications for spousal benefits and things that were done away with at the end of 2015, or at least started phased out at the end of 2015. So then I thought all the attention was going to go to the reverse mortgage because of this huge growing line of credit. In 2017, they did tweak the rules. They didn't eliminate this growing line of credit concept, but they took some of the fun away from it. It still exists, and if you had a loan open before 2017, you'd still be under those old rules. So the government has taken action to reduce this growing line of credit, but they did not go all the way to eliminating it entirely. Why, maybe Dan Holquist later can address in the Q&A, but they did at least move in the direction of taking some of before this, you should have seen what some of these tables and charts look like. Okay, so the growing line of credit. Now, when you spend from the home equity conversion mortgage, you could take out a lump sum, and with the fixed rate option, that's all there is. You could turn on a 10-year payment to get that monthly income. You could have a term payment, which is for a fixed period of time and then would stop. And then you have that line of credit as well. And you can carve out, okay, I want part for a 10-year term payment, part for a line of credits, or part to refinance a mortgage. So you've got modified 10-year modified term payments. And on my website, I do have a really simple reverse mortgage calculator. It's basically an Excel spreadsheet that can just let you play around with what these numbers would be based on a home value and age, and it automatically updates for where interest rates are. You can see, and you can put in what are the costs going to be to set this up. It'll show you the initial net principal limit available, and it will show you what that would be as a 10-year payment. You can also make it a term payment for a set number of years and see what those would be on an annual basis. And it's just, there's no request for email addresses or anything. It's just on retirement research. You can just go to retirementresearcher.com, and then on the top, one of the menus will show reverse mortgage calculator. You can get an idea of what this can look like for different home values, different interest rates, different ages, that sort of thing, to just get a feel of what these numbers look like. Okay, now I really want to dig into a case study about this. Okay, so I'm going to use historical data from Robert Shiller going back to the 1870s. The reverse mortgage program, the HECM program, was created in 1989. So when I talk about using a HECM in 1962. There was no HECM at that time. All I'm doing is I'm saying, you're using today's tax laws, today's HECM rules, you retired today, but you got the market returns from 1962 through 1995. Or you got the market returns from 1920 through 1950. It's just I'm using the historical data for that purpose to look at how different interest rate environments and different market return environments impact comparable strategies on how will I incorporate home equity into this retirement plan. So that's what the historical data is for. It's based on today's rules, today's tax laws. We've got a couple, they both turned 62. I missed updating this slide here, but they turned 62 at the start of 2024. They're already retired. Their planning age is 95. I've set the bigger the home value relative to the investments, the bigger the potential impacts of the HECM. I set this up so their investments are double the home value. So they have $900,000 in investments. That's $290,000 in a taxable account with a 160 basis, $510,000 in an IRA, $100,000 in a Roth IRA, and then they have a $450,000 home that they own outright. There's no mortgage on that home. It's paid off. The HECM terms, 2.5% lender's margin. I'm assuming the full retail cost, and my reverse mortgage calculator can help you also see that the big cost is the mortgage insurance premium, 2% of the home value up to that lending limit. So I'm assuming the full $19,000 upfront cost here, not paid out of pocket, but financed into the loan balance. And so that's where, if there's going to be a benefit of the reverse mortgage, it has to be net of, the full retail costs are incorporated here. It's got to be net of those costs. I'm not going skimpy on the reverse mortgage costs. It's the full retail value. And I'm going to use 1-year treasuries for the effective rate with the historical data. And they do have, so they've got investments, they have the home, and then Social Security at $45,000 total for the couple. If they claim at 67, their full retirement age. In the book, I also look at different claiming strategies too, but for this, they just claim at full retirement age. Their spending goal, they want to spend $67,000 a year pre-tax, and that's inflation adjusted. They also, for their go-go years through 74, add another $10,000 to that, non-inflation adjusted. They live in a state with no state income tax, but they do have to pay federal income taxes, which I will calculate for them. The way they'll spend, if they have Social Security, that's part of their spending. If they have a 10-year payment, they're going to get automatically that 10-year payment from the HECM, or any other money they take from the HECM. Any RMDs also come out first. And then, if that's not enough to meet their spending, they're going to use a relatively decent tax-efficient strategy. That's you go much deeper into better strategies, but they'll spend taxable account first, then tax-deferred, then Roth IRA. We can do better than that, but that's a relatively decent baseline tax-efficient retirement distribution strategy. I'll track their taxes on federal ordinary income, preferential income, Social Security benefits, Medicare surcharges, and the net investment income tax. They'll use a 60-40 portfolio, and I'll calculate the legacy as, because of the step up in basis, 100% of anything left in the taxable account. I'll assume their adult children are the IRA beneficiaries getting that IRA in their peak earnings years, and with the Secure Act having to take that out in 10 years, 25% marginal tax rate on the beneficiary. I simplify there, I'm not doing the full tax picture for beneficiaries. So 75% of the IRA is part of the legacy, 100% of the Roth is part of the legacy. There's still a 10-year window, but it's not taxed to the beneficiary. And then 95% of the home value, which I assume is going to be growing at the rate of the Case-Shiller Home Price Index. We have that data going back to 1890. And then because it's a non-recourse loan, the home you can't have a negative, the reverse mortgage loan balance can't exceed that 95% appraised value. So legacy is 100% of the taxable assets, 75% of the IRA, 100% of the Roth IRA, plus the value of the home minus the loan balance due. But the loan balance can't be greater than the value of the home. And it's based on, because that home price index going back to 1890, and then because it's a non-recourse loan, the home you can't have a negative, the reverse mortgage loan balance can't exceed that 95% appraised value. So legacy is 100% of the taxable assets, 75% of the IRA, 100% of the Roth IRA, plus the value of the home minus the loan balance due. But the loan balance can't be greater than the value of the home. And it's based on, because that home price index only goes back to 1890, It's the historical data I'm using for this. I'm going to do the rolling historical simulations. What if they got the market returns from 1890 through, I get 1923, 1891 through 1924, and so on up to the present. Now, the first point about that historical data is this idea of line of credit growth. This is for looking at if I open the line of credit at 62 versus waiting to a later age to open the line of credit based on the historical changing interest rates, changing home values. The home's initially worth $450,000, upfront costs, which also will inflation adjust. The home value inflation adjusts for the home price index, lender's margin of 2.5%. What this is telling you is that in that historical data, between 60 and 80% of the time, you would have more funds by opening it at 62 and letting the line of credit grow instead of waiting. Now, if you wait, you should get more credit. If the home is worth more and at a higher age, you get a higher percentage of the home value. So you do get more credit by waiting, but this is telling you that 60 to 80% of the time with this historical data, you would have had more credit by opening at 62 instead of waiting and letting that line of credit grow. Plus, you can refinance if you open at 62. What we saw that happened over the last few years, home prices appreciated dramatically and interest rates headed towards zero. That created a scenario where you would have been better off to wait. However, if you already had it open, you simply refinance and you get that. So if you're in that 20 to 40% of the time where you would have been better off waiting, you simply refinance at that point, and you're really setting up the situation to have more funds available to help that retirement plan by opening the line of credit sooner rather than later. And so here's just, I like using that 1962 example where the yellow, so this is, they're 62 years old in 1962. That's another fun thing of it. And the yellow curve is how much they could get if they wait to open the reverse mortgage. It's based on the historical interest rates at those subsequent years. It's based on how the home price evolves with the Schiller Case price index over those years. The cyan colored curve is how that line of credit would grow if I open it at 62. And then the purple is the actual home value from starting at $450,000 in 1962 and then growing with the Case-Shiller price index. So you can see in this example, in 1992, the line of credit would have exceeded the value of the home. And that's just an example of how that sort of thing can happen. And this wasn't really, the home didn't appreciate, although it did kind of trail off there in the late 1980s. But that's just an example of that idea. And here is one of those cases where you're much better off by opening it sooner rather than later. That cyan curve is so much higher than the yellow curve. That means more line of credit by opening at 62. Okay, now the portfolio coordination strategy. And this is where all the interest has been. In 2012, two different sets of authors that at the time did not know about each other's work, they effectively each wrote articles making the same point. Now, they didn't know about each other's work, and so they approached it differently. But it had the same underlying point, which strategic use of a reverse mortgage standby line of credit can create retirement income efficiencies to its contribution to managing sequence of returns risk in retirement. Both of these articles were published in the Journal of Financial Planning, the Financial Planning Association's journal, 6 months apart in 2012. You had Barry Sachs and his brother reversing the conventional wisdom, using home equity to supplement retirement income. Then you had I call them the Texas Tech team because they're all on the faculty of Texas Tech University. Standby reverse mortgages, a risk management tool for retirement distributions. This is the portfolio coordination strategy. This is, I'm going to spend from my investments, but if my investments are in trouble, and they defined that differently, but if my investments are in trouble, I'm going to temporarily spend from the reverse mortgage and see how that impacts the long-term outcomes versus I just keep blindly spending from my investments until they're gone, and then I open the reverse mortgage as a last resort. So following from that sort of research, I'll do simulations along the same sort of line. I'll also look at the 10-year payment, which there was another article published, I think that one was in 2013 in the Journal of Financial Planning, that started talking about how cool the 10-year payment option can be. So look at the 10-year payment option. We'll look at a portfolio coordination strategy with no voluntary repayments, and then we'll also look at one where you can voluntarily, if markets recover sufficiently, you voluntarily pay down the loan balance so that you can have more line of credit for the future. And we'll compare that all to the last resort, which is I don't think about a reverse mortgage until my investments are depleted. Then I'll open a reverse mortgage. Now, for the portfolio coordination strategy, I've looked at a lot of different decision rules, and I found one that seems to work as well as anything more complicated, but it's easier. And you simply note the value of the investments at retirement. And you don't worry about inflation adjustments. You just, okay, I said that they had $900,000 of investments at retirement, so just keep track of that number. At any point when they're taking a distribution, if their remaining investments are worth more than $900,000, they spend from the investments. If their remaining investments have dropped below $900,000, they spend from the reverse mortgage while there's line of credit available. If they fully deplete the line of credit, then they're forced to go back to spending from the investments again. And that's the decision rule. And then with the voluntary repayment, it's 1.25 times 900,000. I forget that, like 100 or $1.07 million, something like that, where if the investments ever rise above 25% higher than 900,000, then they start voluntarily paying down any loan balance that there is. Now this slide's not so important. We'll look at some visuals instead, but this is comparing across the distribution of outcomes, how these different strategies perform. The punchline is the 10-year payment comes out looking really good, but let's look at that in more detail. So first, this is net legacy with the last resort option. So this is if I use the reverse mortgage as the last resort and I try to meet that spending goal over 34 years, how much is left for legacy? It's the value of my investments plus the value of the home minus any loan balance if I did end up using a reverse mortgage. The circled points are when I ran out of investments and had to tap into the reverse mortgage. If the circles are above 0, it meant that my last resort saved my retirement. I made it through age 95 and I still had line of credit left. In the 1960s and 1 year in the 1970s, the circles are below 0. That was a retirement failure where I ran out of investments, I used the reverse mortgage as a last resort, and then I subsequently used up the full line of credit and I could not meet my entire spending goal for retirement. So most of the time with the last resort, you didn't have to tap into the reverse mortgage. And in some cases, you see like early 1920s, early 1980s, you have huge legacies at the end. 1982 is going to be an anomaly with this because interest rates got super high. We're talking like 16% 10-year treasuries at that point. And also market returns did really well after 1982. That will be 1 year where the reverse mortgage ends up not helping very much. But we're going to start to see, we're going to compare this last resort to the 10-year payment and the portfolio coordination strategy. So here's compared to the 10-year payment. Now what's happening here is we're comparing, I'll use a 10-year payment option versus I'll use the last resort option. If the data is above 0, it means my net legacy was bigger with the 10-year payment option. If the dot is below 0, it means my net legacy is bigger with the last resort option. Now, most of those last resorts, you never had to open the line of credit, so you never had to pay those upfront costs. But nonetheless, the 10-year payment's reducing pressure on the investments. So historically, much of the time, you have a bigger net legacy with a 10-year payment instead of using it as a last resort. Now, I mentioned 1982 is going to be an anomaly here. It's just 16% interest rates coupled with, which meant you really couldn't get much out of the reverse mortgage, coupled with the markets did really well anyway after 1982. And so you never needed the reverse mortgage anyway. The last resort did come out ahead. But if I'm thinking of this as just what strategies give me a good shot at a better outcome, the 10-year payment's winning most of the time. And if we put it into a risk management context, this is now plotting the value of that legacy with the 10-year payment vertically and with the last resort option horizontally. And so then there's the diagonal line. If the dot is above the diagonal, the 10-year payment gives you a bigger legacy. If the dot is below the diagonal, the last resort gives you the bigger legacy. So sometimes when the last resort option's winning, it's when legacies are huge anyway. It doesn't necessarily matter that much. If we look at the cases where there's not going to be a big legacy anyway, we see the 10-year payment has a good shot at coming out ahead there. So it works as a risk management technique for retirement. There were 5 points where the last resort failed. They couldn't meet their whole spending goal. 100% of the time, they can meet their full spending goal with the 10-year payment. All those dots are above the diagonal when the legacies are otherwise small. The 10-year payment is supporting a larger legacy when market returns were not great and there otherwise wasn't going to be a very big legacy. So you can judge this differently, but I think this is pretty compelling that just taking the reverse mortgage at 62, turning on a 10-year payment, works a lot better than treating the reverse mortgage as a last resort option for a household where they're anticipating staying in that home in retirement. And here's the same charts, but comparing the portfolio coordination strategy to the last resort option. And it's a very similar kind of situation where dots above 0 means portfolio coordination is supporting more legacy. Odds are you get more legacy with that portfolio coordination approach. Oh, and I don't have but it's also the same for that risk management where the portfolio coordination is generally coming ahead when those legacies are not going to be very big anyway. So to wrap this up, you can't just think about a reverse mortgage in isolation. You can't just think about, oh, those upfront costs, it looks too expensive. You have to look at how it impacts the overall plan. And the way it can impact an overall plan is to help support more efficiency for those retirement assets, meeting the spending goal and preserving a larger legacy at the end. The conventional wisdom idea of just treating the reverse mortgage as a last resort hurts retirement sustainability. Strategic HECM use improves that sustainability, supports a larger legacy, because it helps manage that sequence of returns risk problem in retirement. And that growing line of credit can really help contribute to that as well. Now, the HECM program is more of a middle-class mass affluent type thing because it works better when the home's not well in excess of $1 million and when the home is relatively valuable compared to the size of the investment portfolio. It can be used by much wealthier individuals too, but really this is something that Americans, a couple $100,000 of savings up to a couple $1 million of savings, they really can benefit the most from strategic use of home equity as part of their retirement plan. And responsible use of home equity in this manner can really help improve those retirement outcomes. Thank you very much.
All right, thank you, Wade. And Wade will be back in a little while for the question and answer session.